For the past 2 years, the trade was simple. Buy whoever was selling AI infrastructure. GPUs, data centers, networking, power systems. It barely mattered what valuation you paid. If it touched AI, markets bid it up. But now, Wall Street is starting to ask a much more dangerous question. What if the biggest money in AI is about to move somewhere else? Because two heavyweight camps just collided head-on. Goldman Sachs says the easy money in chips may already be over. SemiAnalysis says Wall Street still doesn't understand what AI is becoming. And underneath this fight is a much bigger battle. Not whether AI wins, but who captures the profits. Because the AI economy is starting to split apart. So here's why Goldman is nervous. The first phase of AI was easy to understand. No matter what AI product you built, eventually you had to buy compute. So naturally, profits flowed upstream first, straight into companies like NVIDIA, TSMC, memory suppliers, networking vendors, power infrastructure companies. That became the safest trade on Earth. But Goldman thinks something now looks structurally wrong. The infrastructure layer is making massive profits. While much of the downstream economy is still struggling to monetize AI, consumers still expect AI to be cheap. Enterprises are still experimenting. Most companies still don't fully know where AI actually saves money, how much productivity it creates, whether the ROI is real. But meanwhile, cloud companies are spending like the future already arrived. Hundreds of billions in CapEx, massive GPU purchases, huge data center buildouts. Even debt issuance tied to AI infrastructure started exploding. And this is the part Goldman worries about. The people buying the GPUs are not yet making proportional returns. That's dangerous, because eventually, one of two things happens. Either AI monetization accelerates fast enough to justify all this spending, or cloud companies slow CapEx, and the entire upstream AI trade suddenly loses momentum. That's why Goldman's positioning is surprisingly controversial. They're becoming more constructive on cloud platforms, while turning more cautious on semiconductors, because they believe the current profit distribution is too extreme to last. But SemiAnalysis thinks Wall Street is missing the point. SemiAnalysis basically responds with, "You're analyzing AI like it's SaaS software." And that's the mistake. Because AI is no longer just generating text. It's starting to generate labor. And this changes the economics completely. This is the part most people still underestimate. The first generation of AI felt like a chatbot. The next generation looks much closer to a digital worker, writing code, running research, managing workflows, handling analysis, executing tasks autonomously. That means tokens stop behaving like a software expense and start behaving like productive capital. A few dollars of inference can suddenly replace hours of high-value cognitive labor. And once that happens, the willingness to spend changes dramatically. Because companies don't hesitate to spend money on labor that increases output. That's why SemiAnalysis thinks Wall Street is massively underestimating future AI demand. In their framework, AI isn't becoming a software feature. It's becoming industrial infrastructure for knowledge work. And that's a much bigger market. And this is where things get interesting. For years, the market assumed frontier AI labs were fundamentally bad businesses. Huge compute costs, massive cash burn, no durable margins. But now, that assumption is starting to crack. Some frontier labs are reportedly reaching surprisingly strong inference economics. And if inference margins continue improving, then the entire AI stack may need to be repriced. Because suddenly, model companies stop looking like loss leaders and start looking like potential platform monopolies. This is where the debate becomes really interesting. Goldman sees infrastructure profits peaking. SemiAnalysis sees the total AI profit pool still expanding. Those are very different worlds. Which brings us to NVIDIA. At the center of all this sits one company, NVIDIA. And the disagreement here is almost philosophical. Goldman's view is straightforward. NVIDIA already captured the easiest phase of the AI boom. Margins exploded. Valuation exploded. The obvious trade became crowded. But SemiAnalysis sees NVIDIA differently. They argue NVIDIA controls the scarcest resource in the AI economy: compute liquidity. In fact, they compare NVIDIA to a central bank for AI. Because in this new economy, compute behaves almost like money, and NVIDIA controls the supply. What's fascinating is that SemiAnalysis believes NVIDIA hasn't even fully exercised its pricing power yet. Not because it can't, but because pushing too aggressively could damage the ecosystem, raise prices too hard, and customers accelerate custom silicon, or governments intervene, or hyperscalers vertically integrate faster. So instead, NVIDIA appears to be optimizing for something bigger, maximizing the long-term size of the AI economy itself. Because if the AI market keeps expanding, then the value of controlling compute infrastructure may become even larger over time. This is the part many investors still struggle to process. The biggest risk for NVIDIA may not be competition. It may be AI becoming too cheap too fast. So what actually matters from here? At this point, the AI trade is no longer simple. The market now needs proof. 3 things matter most from here. First, can cloud companies actually monetize all this AI capex? Not demos. Not user growth. Actual revenue leverage. If they can, cloud stocks may re-rate violently higher. If they can't, Goldman's concerns become very real. Second, who owns enterprise workflows? Because the real money may not come from AI models alone. It may come from controlling enterprise data, permissions, integrations, operational workflows. The company that embeds AI deepest into daily work may end up owning the highest margin layer of the stack. Third, can NVIDIA and TSMC maintain pricing power? As long as advanced packaging, HBM memory, and cutting-edge nodes remain bottlenecks, value may continue staying upstream much longer than bears expect. And that's really what this fight is about. So, no, the AI shovel trade isn't dead. But the easy phase is probably over. The market is no longer asking, who sells the shovels? Now it's asking, who becomes the landlord of the AI economy? Because this is no longer just a semiconductor cycle. It's becoming a battle over who controls compute, labor, productivity, pricing, power. And right now, the market still hasn't decided where the profits finally settle. The strongest AI users are already spending aggressively. Average enterprises still aren't sure how much AI is truly worth. That gap is where the entire debate lives. If enterprise adoption accelerates fast enough, SemiAnalysis may be right. If monetization stays slow, Goldman's positioning may win. Either way, one thing is becoming clear: the AI trade is breaking apart. And the next phase will be much harder than simply buying chips.